If you look at your trading app right now, it tells you silver is trading at $79. That is the spot price. It is supposed to be the global price of silver. But if you fly to Shanghai and walk into the gold exchange, you cannot buy silver for $79. You have to pay $90. This represents an $11 premium, or roughly 14% higher than the Western price. In a functioning market, a 14% gap is impossible. Arbitrageurs would close it in seconds. But the gap isn't closing, it is widening. This tells the smart money one thing: the Western price is fake. The market is broken. We are witnessing a massive flow of physical wealth from west to east. Traders are buying every ounce they can get in London and New York at the discount price, melting it down and shipping it to China. The West is being drained of its strategic metals at a fire sale price, and by the time we realize it, the vault will be empty. Let's look at the mechanics of this bank run. It works like a siphon. Investors in New York buy a futures contract on the COMEX for $79. Instead of selling it for cash profit, they hit the Take Delivery button. The COMEX warehouse must give them a 1,000-ounce bar. They take that bar, put it on a plane to Shanghai, and sell it immediately for $90. They make an instant, risk-free profit of $11,000 per bar, minus shipping. Why doesn't everyone do this? Because it requires physical infrastructure. You need vaults, planes, and licenses. But the big players, the Glencores, the Trafiguras, the Chinese banks, are doing it at industrial scale. They are essentially arbitrage machines. Every day this gap exists, registered inventory leaves the COMEX. We are seeing inventory levels drop to historic lows. The registered category, silver available for delivery, is down 70% from its peak. The siphon is running dry. Why is silver more expensive in China? Is it just speculation? No, it is industrial necessity. China produces 80% of the world's solar panels. As we discussed in episode 012, new solar tech, TOPCon, uses 50% more silver. A Chinese solar factory manager doesn't care about the chart pattern. He cares about the assembly line. If he runs out of silver paste, the factory stops. That costs millions. So he bids the price up. He pays $85, he pays $90. He pays whatever it takes to secure the metal. This is inelastic demand. The Western price, $79, is set by paper speculators trading on margin. The Eastern price, $90, is set by industrial users trading for survival. The physical market, East, always wins against the paper market, West, in the long run. China is setting the real floor price. New York is just living in the past. The situation is even worse in London. The LBMA, London Bullion Market Association, holds the world's largest silver stockpiles. On paper, they claim to have hundreds of millions of ounces. But forensic analysts have looked at the data. Most of that silver is owned by ETFs, like SLV, or private family offices. It is encumbered. It is not for sale. The amount of float, silver that can actually be bought and shipped to China, is estimated to be near zero. We know this because lease rates are spiking. When it costs money to borrow silver, it means there is none available. London is effectively empty of liquidity. They are scraping the bottom of the barrel to fulfill delivery requests. This is why the price won't crash back to $30. There is no metal to sell to drive the price down. So how does this end? It ends when the COMEX cannot deliver. This is the force majeure scenario. One day, a major entity, maybe a tech company like Tesla or a sovereign wealth fund, will stand for delivery of 50 million ounces. And the COMEX will say, we don't have it. At that moment, the exchange will declare a liquidation-only emergency. They will force everyone to settle their contracts in cash at the last traded price. Let's say the last trade was $79. You get $79 in your account, but the real price of silver in the street will gap up to $150 overnight. You get your fiat currency back, but you cannot buy the metal. This is the ultimate rug pull. The paper price goes to zero, irrelevant, and the physical price goes to the moon, unobtainium. If you are holding unallocated paper silver when this happens, you lose. There is a geopolitical layer to this arbitrage. China knows exactly what it is doing. They are converting their U.S. Treasury bonds, which are losing value due to inflation, episode 03, into strategic commodities. They are cornering the market on silver, copper, lithium, and rare earths. They want to control the supply chain of the 21st century. By draining the West of silver, they gain leverage over Western industry. Imagine if the US military needs silver for missiles, but has to buy it from Shanghai at a 100% markup. That is a national security crisis. The smart money expects the US government to eventually ban silver exports. When that happens, the global market fractures. The arbitrage stops, but the price explodes. The arbitrage window is open, but it won't be open forever. How do you position yourself? 1. Avoid unallocated accounts. If your silver is in a pool account at a bank, you are at risk. You are an unsecured creditor. Get it allocated or get it out. 2. PSLV is the king of ETFs. Unlike SLV, Sprott actually buys the metal and takes it out of the market. They are part of the drain. Buying PSLV puts pressure on the COMEX. 3. Physical in your hand. This is the only asset with zero counterparty risk. With silver at $79, the premiums are high, but the security is absolute. 4. Watch the inventory numbers. Subscribe to updates on COMEX registered stocks. When that number drops below 30 million ounces, we are in the danger zone. The silver is moving east. If you want to own it, you have to grab it before it gets on the plane. Let's summarize the investigation. The price gap between New York and Shanghai is the smoking gun. It proves the shortage is real. The smart money playbook: 1. Do not trust the paper price, $79. The real price is the Shanghai price, $90. 2. The arbitrage will eventually break the exchange. Prepare for a cash settlement event by owning physical. 3. This is a geopolitical transfer of wealth. Don't be on the wrong side of the border when the gates close. 4. If you missed the $30 silver, don't worry. $79 is still cheap if the real price is $300, episode 14. The vacuum is running, the vaults are draining. This is the smart money wisdoms. The future belongs to the owners.